All right, welcome back. Today we're jumping into a story that honestly has all the makings of a Wall Street thriller. We're talking about a brand new ETF, a price drop that looks really suspicious, and a company that's sitting on what you might call a king's ransom in crypto. Yeah, we are investigating the alleged BMNR ETF trap.
Our source material on this kicks things off with a pretty dramatic claim, basically alleging a deliberate, calculated deception at the highest levels of finance. So you know what? Let's get into it and see what this accusation is all about.
So we're going to start with the absolute core of the story, this alleged market manipulation. You know, a classic, dirty trick that's supposedly designed to help the big fish win at the expense of, well, everybody else. So how did this so-called trap actually work? Well, the sources lay out a pretty simple four-step playbook. First, a new ETF called BMNR launches, and boom, that instantly creates a huge demand for shares of BMNR. Now here's the problem if you're an institution. How do you buy millions of shares without sending the price to the moon? Well, according to this theory, you drive the price down. The allegation is that these big institutions orchestrated a massive sell-off. This triggers all the stop losses, those automatic sell orders people set up, and it creates widespread panic. And just like that, this flood of selling creates the perfect pool of cheap shares for them to scoop up right around that $29 mark. And that's the real kicker here, the motive. The whole point wasn't that the company was suddenly worth less. It was all about manufacturing fear. Why? To build a massive inventory for their brand new ETF on the cheap. It's a simple but brutally effective strategy, if the allegations hold up.
And this right here, brings us to the most important question of all. If that $29 price tag was just an artificial low, basically a manufactured discount, then we have to completely ignore all that market noise and ask, what do the cold hard numbers say BMNR is actually worth?
Let's move on and see how this all stacks up. We're going to pivot now from the alleged Wall Street trickery to the tangible, verifiable assets on the company's balance sheet. And believe me, this is where the story gets really, really interesting.
So, based on everything the company holds, we're talking cash, infrastructure, and its absolutely massive crypto treasury, the analysis calculates what's called a net asset value, or NAV, of $41 per share. Now, if you're not familiar, just think of NAV as the company's real sticker price. It's what each share would be worth if you just sold off all the assets and paid off all the debts today.
So where does all that value come from?
Well, the crown jewel is the company's treasury. Get ready for this. It holds a staggering 3.63 million Ethereum coins. That number is almost hard to wrap your head around.
And to put that number into perspective for you, this single holding makes BitMine the #1 Ethereum treasury in the entire world. They control about 3% of the entire global supply of ETH. That isn't just a strong position. That is systemic influence. And this just brilliantly illustrates the disconnect we're talking about. When the stock was trading at $29 during this supposed trap, the market was basically offering a 30% discount on the company's actual, verifiable assets. I mean, you could essentially buy $1 worth of BMNR for just 70 cents.
But look, just holding a bunch of assets, even a ton of them, still leaves you exposed to wild price swings. So the next chapter in this story is all about the company's plan to completely change that equation, to transform its massive treasury into a predictable, reliable cash flow machine.
First things first, you gotta know they're already highly profitable. They reported a net income of $328 million. But the real game changer here is the plan to generate an additional $300 million in passive income every single year. It's like they're gonna start earning interest on their massive crypto holdings.
So how are they going to do it? Through a project they're calling MAVIN, the Made in America Validator Network. So by staking their giant pile of ETH, which just means locking it up to help secure the network in exchange for rewards, they can generate this really stable, recurring stream of revenue. And this is a huge deal because it fundamentally shifts their identity from being a volatile asset holder to a stable tech infrastructure company, one that's shielded from crypto's insane price swings.
So what's the grand strategy here? What's the end game? Well, it's not just about holding what they've got. It's about a really clear, ambitious plan for strategic dominance, a plan that our sources are calling the Alchemy of 5%. In the playbook they're running, well, it should probably sound pretty familiar. Just like MicroStrategy used financial instruments to become a Bitcoin behemoth, Bitmain, led by Fundstrat's own Tom Lee, is doing the exact same thing for Ethereum. And their stated goal? To go from owning 3% of the world's ETH all the way up to controlling 5%.
So let's be really clear here.
This whole aggressive accumulation strategy is a highly leveraged bet. It's totally built on Tom Lee's deep conviction in what he calls a crypto supercycle, this belief that the price of ETH is just poised for an exponential explosion. If he's right, the returns for this company could be absolutely massive.
Okay, so we've got the fundamental value, we've got the long-term strategy, but let's circle all the way back to that trap that started this whole conversation. Were there any technical fingerprints on the charts suggesting that that big drop was just an artificial event?
Well, it turns out there were. Right at that 29 low, what do you know? A classic reversal pattern popped up, the Morning Star Doji. Now, for those of you who don't live and breathe charts, this pattern is like a textbook signal. It screams that the selling pressure is totally exhausted and a price reversal is probably right around the corner. It's basically the technical footprint of a bottom being formed.
But wait a second, you might be thinking, what about all that high trading volume? Doesn't that usually mean heavy selling? Well, in this context, it's interpreted very differently. See, the price didn't keep spiraling down, it stabilized, and that suggests the volume wasn't distribution, it was absorption. It was the smart money soaking up all that panic selling like a sponge to fill up their ETF orders.
So what does all of this mean going forward? Well, the analysis lays out 4 key price levels to watch. That $28.50 to $29 range is seen as the institutional support zone, their buy-in area. A close above $31 would be the big technical trigger that confirms the reversal is for real. After that, the first target would be $34.50 to fill the gap that was created by that big drop. And then there's the moon target. If that whole supercycle thesis plays out, the projection is 90 plus, based on the kind of valuation multiples that a company like MicroStrategy gets.
This slide right here really just pulls the entire narrative together. On one hand, you've got this alleged short-term trickery, a game played by Wall Street just to get cheap inventory. And on the other hand, you have this incredibly compelling long-term value case built on a $41 net asset value, a plan for massive passive income, and one heck of a big bet on the future of crypto.
Which, of course, brings us to our final question, and it really encapsulates the core conflict we've explored today. When you see this battle raging between Wall Street's short-term games and a company's powerful long-term fundamentals, where does the smart money really lie? Now that is something to think about.